Let's go back to Mike Santoli, who is checking out the chart. Mike.
Yeah, Sarah, I mean, the Wall Street Journal today presented it as a question of whether investors are getting overconfident. This little jump in margin debt that we saw. This is the orange line going back 23 years or so. So it's not out of whack right now. In fact, what's interesting is that we didn't make a new high in margin debt for this entire period of more than 2 years. So maybe it develops into a problem. Maybe this fits in with a lot of other indicators of heavy speculation going on right now. But in itself, it's more of a coincident indicator and tells you that the market's been rallying and the value of people's portfolios is higher. They're willing to take on some borrowing against it. Doesn't, to me, tell us that there's a particularly vulnerable condition right there in the markets.
What does it tell you, though, about how exposed people are to things like leveraged ETFs and other ways that they take on this debt?
Yeah, that doesn't actually get measured in here. So I could point to a lot of other things. But to me, borrowing against your portfolio with a margin loan is not right yet telling you that things have gone around the bend.
There was another craze that captured America's attention in the 20s. If you wanted to buy 1,000 shares of a company's stock, which is priced at $10 a share, the total price would be $10,000. But you could purchase all 1,000 shares by paying only $1,000, 10% of the full price. This down payment is known as the margin. When the shares rose in value, as they always seemed to do in the 20s, you paid off the loan with your profits. This is called buying on margin, and as long as the value of the shares kept going up, everything would work out okay. But if the value of the shares dropped dramatically, you'd still be liable for the $9,000 loan. You'd still have to pay it back, and your broker would be putting pressure on you to do just that.